Initial claims, they dropped 1,000 from a slightly revised 214 last Thursday. That moves up to 217 on the revision, and then that moves down 1,000 to our arrived at destination of 216,000. And continuing claims a week in arrears, fairly lateral from 1.705 to 1.701 million. And indeed, Melissa Lee is right. The November read on new home sales will be delayed due to the shutdown. Conference Board Consumer Confidence at 10 o'clock Eastern should be released normally. We're at 275 in tens, as you mentioned, Melissa Lee. The issue is we're at 279 on our way to 280 yesterday when we had our 1,000-point run in the equity market. So you can see that as markets thin out a little bit, the dollar index and treasury yields paying particularly close attention to the weakness or strength in the equity complex. Joe, back to you.
Thanks, Rick. Steve Liesman joins us now with more. 216 is still a pretty good number, Steve.
Yeah. So we used to think 300 was the number to get worried about, and then we didn't get worried. We were nowhere near there. So we've now established a new get worried number, which is 250.
Okay.
I'm not sure that's the right number. I'm not really sure of the relationship of claims anymore because they've made it a lot harder to get them. They throw you off a little earlier. There's some evidence about that the Licio report has done, looked around for there. So it's unclear how good I think if it spikes up, which we had a little spike up, there's a little nervousness, it's come back down. I think that as a near-term indicator, it's not too bad. I do want to talk about how much the economic data may be contributing to this amount of concern that's out there. Let me first show you the Goldman Sachs Economic Surprise Index, which, okay, so first of all, it's all still positive. I hope you can get that from all the surprises are either positive or down towards zero, as in not so many surprises. I think relative to the surprises we had earlier this year, there are many fewer upside surprises, but we're not surprising negatively. And then I want to show you some of the fundamental data that we've got and how they have performed relative to expectations. And what's wrong with this analysis, it doesn't tell you level. It just tells you how you did relative to the last time and whether or not you missed or beat expectations. Retail sales better. Home sales, by the way, have been better. You notice the last couple ones have been pretty good. Consumer confidence, the last consumer confidence numbers were better. Auto sales directionally down, but they did beat expectations, still at a decent level. And then one more screen here, if you will. The jobs data was down, missed on the estimate, but still a decent level. Fed manufacturing services, those are the ones that are spooking people out.
Like Richmond.
Richmond, Philly Fed, Empire State. I don't know how much to do with those. We've got some experts here might tell us. Biz investment has been down relative to the prior and also missing expectations, and then NFIB as well. Still, we are tracking 2.9 on Q4, which is, depending upon your particular religion, a percentage point or higher relative to expectations. And there's where first look at our CNBC rapid update for Q1 19. Still going to do 2.8. It's a good number.
Where should the 10-year be if it wasn't for all the tumult?
I would say a quarter point at least higher. And what's interesting, Joe, is you have eased. The financial conditions have eased pretty dramatically.
But the Fed is tightening. We're 275 again.
Yeah, and there's a problem with that if you want to start thinking about it, which is the Fed wants to tighten conditions a little bit. And what have conditions done? They've eased. So, I mean, maybe the Fed is okay with this because of the
housing,
uncertainty.
though? That's been one of our trouble spots.
I think you may be seeing it already, Joe, right? Is you've had this somewhat better housing data. I don't know if that bakes in the recent decline in mortgage rates, but
are you surprised that we're not at 3? We're not at 3.5 again. We're back to 2 3/4. This is so weird.
3 1/4 was my prediction for the year. We got there eventually.
Yeah, but we're not there anymore.
We're not there anymore.
That.
But luckily, I don't get paid to trade bonds.
I know, but it just
I get paid to help people either by ignoring me or listening to me on bond trading.